Hello and welcome. The study of economics is often called the dismal science, and considering recent developments in the US markets, even economists might agree. Wall Street awoke to the disappearance of two of its giants, Lehman Brothers and Merrill Lynch, and some have compared the crisis to the Great Depression of the 1930s. The fall of Lehman Brothers is the biggest bankruptcy in American history. It was never an ordinary bank. Founded 158 years ago by a German immigrant, it grew into a multinational giant serving major corporations, governments, and municipalities worldwide. Today, its debts total more than $600 billion. And as mentioned, Lehman wasn't the only one to shock the landscape of American finance. Merrill Lynch agreed to sell itself on Sunday to Bank of America for roughly $50 billion to avoid a deepening financial crisis. On top of all this, the world's largest insurance company, American International Group, known as AIG, says it was days from falling apart. The governor of New York offered some temporary relief, but the company could need up to $40 billion to get back on its feet. So just what are we to expect over the next few days, and how will the instability in the US markets be felt around the world? Don't forget, you can join the conversation anytime. Joining me today is Lakshman Achuthan, the Managing Director of the Economic Cycle Research Institute in New York. The ECRI forecasts national and international business and inflation cycles. He's the author of Beating the Business Cycle. And from Paris, we have Max Keiser, who's been involved with markets and finance for 25 years. He began his career as a stockbroker on Wall Street after graduating from college and went on to become a pioneer in prediction markets. Welcome to the show, gentlemen. And Lakshman, I'm going to start with you with a question. To what extent do you see the latest developments in the banking sector as an indication of worse to come for the U.S. economy?
Well, it probably is an indication of worse to come, or a slight recognition of what's been going on. I mean, these failures are part of the process of the free market kind of dealing with excesses in a somewhat Darwinian way, very violently sometimes, and eventually that'll set the stage for a recovery. But I'd like to step back for a second and look at this in context. In 2006, we began the home price decline. In 2007, the credit crisis erupted. Those are at the epicenter of all of these bailout stories that we've been hearing about in 2008. What's new in 2008 is that we have a recession in the US, which is really exacerbating those bigger issues. It's like the big issues, the 800-pound gorilla is really the home price decline and the credit crisis. And this elephant in the room that not everybody wants to admit, but which is causing a lot of havoc and really agitating this gorilla is the recession, with job losses and the way that kind of makes all of these things continue to spiral down.
Well, Max Keiser, I know that you think the U.S. economy and the U.S. dollar are essentially finished. So what happens next for America?
Well, let's focus on this idea of free markets. As was just mentioned, sure, you might expect for a banking crisis to cycle its way through, or a recession to cycle its way through. What's interesting at this time is that the entire notion of free markets in the U.S. anyway is being challenged, because the federal government is taking onto its balance sheet trillions of dollars worth of debts and in effect nationalizing huge portions of the banking industry, and there's talk now of them nationalizing the auto industry, nationalizing the airline industry. So this is really almost as if America is throwing in the towel on capitalism and saying, well, we tried it, it didn't work, we're going to go socialist. We have a Federal Reserve Bank that sets interest rates according to a Politburo. There's no market discovery or price discovery for interest rates. And the federal government is now running the show. And it's really quite a climb down for an economy in a country that at one time considered itself to be a beacon of free market enterprise, but those days are now behind them.
Well, Max, should the rest of the world be worried?
Yes, I think the rest of the world should be worried, and as should the policymaker. Are they? Yeah, I think they are worried. I mean, I'm sympathetic to what Max is saying as well, and it may be that to a degree, I think the policymakers have themselves in a very uncomfortable position, because they are these supposed proponents of free markets, and then they're bailing things out, largely because they didn't, they let this thing get out of control is really what happened. And now they're really having to do things that I think they're very uncomfortable doing. When we look around the global economy, there was this notion a while back that there could be some decoupling, that the U.S. could kind of take this downturn and the rest of the world could go on its merry way. What you're seeing become very evident this year, probably started around the second or third quarter, is that the rest of the world is turning down as well. I mean, you have a pervasive global downturn punctuated by recession in the U.S. and Southern Europe, perhaps in Japan. I mean, it's a drastic situation where you even have the Bank of China, the Chinese government, cutting interest rates today, for example.
Well, Max, do you think the rest of the world should be worried? And also, how, when you look at some of the things you've been saying, how the U.S. is bailing everyone out and essentially nationalizing, as you put it, can you think of any other government that would spend this kind of money, that would go all out to start saving its banking sector, its airlines, and so on?
Sure, the Soviet Union, circa 1955. And now you have the USSR, the United States Socialist Republic. But let's talk about decoupling for a second, because that's an interesting point. Decoupling is rumored, or it's been talked about, and your guess is right there. There's been some synchronistic downturn in the global economy as these other countries try to work off billions, hundreds of billions, trillions of dollars worth of bad debt that were sold to them by America. But once they get rid of this bad debt, and of course the bailout of Fannie Mae and Freddie Mac was quite convenient for the Chinese, who were guaranteed the bonds to make whole on their bonds, while Americans who hold the stock got zero. So here you have the U.S. government favoring the Chinese masters, as it were, and leaving the American shareholder swinging in the wind. So I think once these foreign banks get rid of this bad paper, this toxic American debt, then this decoupling process, we'll see this decoupling process. The Chinese economy has slowed down, but instead of growing at 12 or 13% a year, I think they're growing at only 9 or 10% a year. I mean, America would be happy with that kind of growth. It's phenomenal growth. And they've already started to stimulate their markets and their economy this week. So I think the Chinese economy is going to go back on the high growth path pretty shortly here, in a short time.
But Max, then tell me how you would handle it. I mean, if you're saying that that this is basically a Soviet era method of bailout, then what would you suggest? I mean, could America afford to let these large organizations, Freddie Mac, Fannie Mae, and so on, go down?
Okay, yeah, sorry, but they can't afford not to let them go down, in a way, because by giving these companies like Fannie Mae and Freddie Mac some assistance, they're actually prolonging the agony and the pain. They're not letting real estate prices fall to their natural level where there might be demand for those properties. They're actually making the situation a lot worse. The problem in America is that after being the empire of the world for so many years, they've grown fat and lazy. They don't want to experience even 5 minutes of a recession. So the Federal Reserve keeps pumping all this ersatz money into the economy, and for every dollar of GDP growth, it takes something like $5 or $6 worth of fresh debt. So eventually, you can't, I think I liken it to a foie gras farm where you're stuffing the ducks with the grain to get them to this enormous size. But eventually, you can't do it anymore. You've got to take that liver out. You've got to harvest the ducks. And this is the problem America faces right now. They can't stimulate themselves with any more debt. They've got to they've got to have a severe contraction right now to get back to some kind of normalcy, but I don't even think that's possible at this point.
Lakshman, let me ask you then. Lakshman, let me ask you then. If obviously Lehman Brothers was a surprise to many people. The government didn't step up, but of course, if it comes to a Goldman Sachs or if any of the others start to struggle, what happens? Do you expect America to stick by its no bailout policy that it seems to have, at least for this weekend?
I think it'll try. At this point, what's going on, I think, is a very belated or weird recognition of the fact that we are in recession. And this is happening with the backdrop of an election, which really skews things. But I think ultimately, this recession train has left the station. It's going to run its course. There's going to be a lot of collateral damage along the way, and that's putting it mildly, which we're seeing unfold here. But to the point of also to decoupling, and I think there's one area where we may disagree, myself and the other guest, is that I think it's more than just about debt. It's also about the interrelationships of demand around the world. And the Chinese do very much have a stake in the continued health of the U.S. economy because of the sheer amount of consumption that goes on here. So we do have ourselves in this global synchronized downturn punctuated by recession. I think you're going to see more recessions probably concentrated in continental Europe. And this is going to be a rough ride for as far as we can see, which is at least a few quarters.
Let's hear what our two phone callers have to say before we take a break. Ali in London first. Ali, what would you like to ask?
My question is perhaps a comment first, and then question is,
please.
But I think what we've seen in recent weeks and months in terms of financial institutions, particularly those based in America, it is the accumulation of a huge wealth, which the fundamental assumptions or fundamental basis which allowed them to accumulate such wealth is the globalization and free market.
Okay. So
don't we need to question those ideologies? I mean, because the affairs impact in terms of global economies is unbelievable and unrecoverable to some degree.
Okay.
So we need to question the theories behind globalization and free market.
Okay, great. Now let's get Abdullah from Morocco as well. Abdullah, what would you like to ask?
Good evening. Regarding Merrill Lynch, don't you think extreme overexpansion plus mismanagement plus high salaries for top management and high premiums at the end of the year and bonuses and share ownership and extreme overexpansion regarding both companies? Thank you.
Okay, gentlemen, I'm going to take a short break here. We'll get to answers for those two questions from our callers as soon as we get back. Stay with us for more on this topic.
Don't